Hello, it's the Insurance Exam Queen, and today we're going to talk about the Fair Credit Reporting Act. So insurance companies want to gather as much data about us as they can in order to determine our premium rates. Since insurance is the transfer of risk and they're going to take our risks from us, they need to know how risky we are. One of the points of data that they use is consumer reports, like your credit score. Since they are pulling credit reports, they need to follow the federal act, the Fair Credit Reporting Act. They need to follow the rules of that, which establish how companies are allowed to use people's credit scores. Now, the purpose, and this is, write this down, this is a test question. The purpose of the Fair Credit Reporting Act is to protect consumers against the circulation of inaccurate or obsolete personal or financial information. I'm going to say that again. The purpose of the Fair Credit Reporting Act is to protect consumers against the circulation of inaccurate or obsolete personal or financial information. So insurance companies are pulling our credit to look at our data. They're using consumer reports, and they have to make sure that they're not using outdated or obsolete personal or financial information when they do that. The information that insurance companies are not allowed to use, the information that would be obsolete and outdated, is any information that is negative and older than 7 years old. So if you have a bad loan, you never finished paying it off, you have a credit card you didn't finish paying off, whatever, and it's on your credit report as a negative ding, insurance companies cannot look at it if it is more than 7 years old. The other thing is bankruptcies that are 10 years old. So if a customer has a bankruptcy on their credit report and it's more than 10 years old, the insurance company cannot use it to determine premium rates. So again, they're using our credit report because it gives us data. It gives them better prediction. People, statistically speaking, people with bad credit file more claims. And so they want to know what our credit is to determine the likelihood of us filing claims. And so they will base our premium off of our credit score, and they have to follow the Fair Credit Reporting Act, which protects consumers against the circulation of inaccurate or obsolete personal or financial information. And the obsolete information is any negative information over 7 years old and bankruptcies over 10 years old. Now, the reports that they pull, the Fair Credit Reporting Act allows them to pull certain reports. A consumer report, like every report is a consumer report, and consumer reports generally are public source of information, credit report, job history, etc. Within the realm of consumer report, there is a specific type. So if we were to imagine like a Venn diagram, all of these are consumer reports, credit reports, and job history reports, whatever. Inside of that is a specific type called investigative consumer reports. An investigative consumer report is unique from a consumer report, like a public source consumer report, because it requires that they interview your friends and family. So a consumer report or an investigative consumer report is where they interview your friends and family. And that's a key word you want to associate. Interview, investigative interview, investigative interview, investigative interview, investigative interview. You know the answer to the test question. If they ask you about consumer reports and investigative, you know it's investigative if they've got the word interview in there, because they have to interview your friends and family. Now, what they're doing on this investigative consumer report, which by the way is rarely done unless the person is asking for millions of dollars of life insurance, but what they're doing with this investigative consumer report is confirming that the person is who they say they are and is not scamming the insurance company for millions of dollars of life insurance. They want to interview friends and family to make sure that this person is who they say they are, that they're a good, trustworthy person, and that they're not attempting to scam the insurance company. That's when they do an investigative consumer report. Rarely, if ever, done, but is done with the $1 million asks. Now, for an investigative consumer report, the insurance company has to tell you they're going to do it. They can't just do it without you informing you. They have 3 days to tell you. So if an insurance company is going to run an investigative report where they are interviewing your friends and family, investigative interview, if they are doing an investigative consumer report where they interview your friends and family, they have to tell you 3 days before they do it. Once they complete the interviews and they come up with their data, their information that they need, if the customer were to ask to see it, they have 5 days to show it to them. So 5 days to let the customer know what data they collected. So with investigative consumer reports, I like to say 3 to tell, 5 to show. Investigative consumer reports, you have 3 days to tell them, 5 days to show. So 3 to tell, 5 to show investigative consumer reports. Now, another big thing about the Fair Credit Reporting Act is that the consumer, the customer, the person buying the insurance, if they let's say that they call into you, they say, my insurance premium has gone up $500 a month. What is going on? And you look into it and you say, oh, well, we pulled your credit report for the renewal, shows you have bad credit. And so your premium went up because your credit's bad. Now, it's not exactly how it works in the real world, but something like that. The customer then has an opportunity to challenge what is in the report. So if you tell them, oh, you have bad credit, you got to go talk to the agency who runs the credit. You're going to go to the reporting agency. It's called a reporting agency. You don't challenge with the insurance company. You challenge with the reporting agency that the insurance company used, like Equifax, TransUnion, whatever. And they're different in the insurance world, but it's all the same, really, at the end of the day. So you're going to challenge the reporting agency. And you say, my insurance, you go to the reporting agency, you say, my insurance rate went up $500, what the heck? And they go, oh, well, on your credit report, you have a bad loan. It looks like you got a loan recently for a car and you didn't pay it off. You're like, what? I didn't get a car. No, you need to look into that. That's not mine. The reporting agency will have to dig into it. Let's say they come back and say, oh, you're right. Sorry, this is not your car loan. You have the same name as someone else. It accidentally got on your report. We'll take it off. So the consumer is allowed to challenge what is in the report and have it amended if it's wrong. And then what's really cool is that the reporting agency gives the new information to the insurance company, and they will have to backdate refunding you the overcharge for up to 2 years. So the way I said it was that you immediately found out at your renewal and you called them. But if they have been overcharging you for the last however many years, they can go back up to 2 years and refund the premium if the premium rating was based on faulty data. So if your credit report has a loan on it that's defaulted, it's not yours. If there's any negative information on the credit report that's not yours and shouldn't be there, when it gets cleaned up, if you go to the insurance company and say, hey, you've been overcharging, you have to do it with the reporting agency, but they can come back and refund you the premium up to 2 years if they've made a mistake. So, Fair Credit Reporting Act, I'm going to summarize all the big points. Since insurance companies pull our credit, they have to follow the Fair Credit Reporting Act. The purpose of the Fair Credit Reporting Act is to protect consumers against the circulation of inaccurate or obsolete personal information. The inaccurate or obsolete would be any negative information that is 7 years old, bankruptcies that are 10 years old. Consumer reports represent all the reports, and that would be public sources, job history, credit report. Inside of that is investigative consumer reports where they interview your friends and family. If they're going to do that, they have 3 days to tell you, 5 days to show you. And that's the majority of and then you're allowed to challenge the report. If there's anything in the report, in your credit report that's faulty and is causing your premium to go up, you can challenge what's in the report. And if they find something wrong and they need to fix it, they can refund your premium back up to 2 years. One last final point with the Fair Credit Reporting Act that they love to ask about is it's a $2,500 willful violation. So if you violate the Fair Credit Reporting Act, you are looking at a $2,500 fine. So every time the insurance company violates it, uses it incorrectly or whatever, up to a $2,500 fine for the Fair Credit Reporting Act. So if that little lesson there helped you out at all, please drop a comment. Let me know if you have any questions. You can find more free resources on my Facebook page, Insurance Exam Queen. And you can also book a tutoring session with me as well. The link is on my Facebook page. I've been doing this for a really long time and I love to help people out. So have a good day.